Natalie Kenway, Global Head of ESG Insights at ESG Clarity, and welcome to this episode of the Green Dream video series where we interview key members of the responsible investment industry. Today I'm joined by Ursula Tonkin, Portfolio Manager of Whitehelm Capital and responsible for the listed Core Infrastructure Fund. Thank you so much for joining me, Ursula.
Thanks, Natalie. Good to talk with you today.
Great. To start with, can you give us a brief overview of the listed Core Infrastructure Fund, the companies it invests in and what it's trying to achieve?
Yeah, sure. So at Whitehelm, we're a specialist infrastructure manager. So most of the funds we manage are actually in direct equity of infrastructure and infrastructure debt. But we also manage the listed fund as well. And the listed core infrastructure fund is designed to be a defensive part of an equity portfolio. So core infrastructure has very nice steady cash flow characteristics, it's monopoly type assets, and it's designed to provide downside protection when markets start to get volatile. So that's the aim of the fund. It's long only, we hold 40 stocks in the portfolio and they're held at equal weight, and it's quite a diversified portfolio across developed markets. And when I say core infrastructure, we're talking about things like water utilities, electric grid utilities, telecommunication towers companies, fibre networks, and transport infrastructure like airports and railways. So basically we're looking for, the most boring companies that we can find that are going to produce long-term stable cash flows. And that long-term kind of sustainability, that's where the ESG really comes into it, because these are very long-lived assets. And you do have to focus on ESG quite a lot. This is the sector where ESG is really the rubber is really going to hit the road, and you have to be very cognizant of the long-term risks. So for the infrastructure sectors, we think it's very important to, particularly around climate change, take a 2-degree maximum warming pathway approach. So that's what we apply to the fund. So only investing in assets that are going to be sustainable over the long term.
Okay, fantastic. Thank you for that. What are the main trends or changes that you're seeing in the space that you're investing in, the utilities, as we shift to this cleaner energy, the renewable energies?
So there's a lot of change in these sectors at the moment. A lot of these sectors have historically been very energy intensive. And so obviously that transition to renewable energy is one of the really big things that you have to be across. And that's been driven by government action in this area, regulation and policy work, but also to a large degree, and perhaps in some countries a larger degree than government action, by the increasing cost of renewable energy such as solar and wind, and increasingly storage as well. So where we invest in these sectors is typically around the grids. We like the poles and wires. We don't because we're very defensive and risk averse, we don't take the risk of merchant power generation. So we don't have exposure to commodity prices within the portfolio, really reducing that risk right down. So that's it, but it's still a really big impact on the grid. So how are grids kind of building out to accommodate these new sources of power, and increasingly storage as well is going to be a big piece of that, and distributed energy. So historically, grids took energy from the big power plant, transported that, through a series of networks to the end user. Now they're going to have to be a lot more smarter, and technology has to be advanced so that power can flow the other way, so that, residential solar systems can feed back into the grid, and there's a lot more balancing required. So that's obviously one of the biggest trends in these sectors at the moment. And what that creates is a lot of opportunities, but also a lot of risk. So a lot of stranded asset risk. And up until recent years, a lot of the focus has been on coal. That's kind of been the easy, kind of low-hanging fruit when we're talking about, say a negative ESG screen, or the way that investors approach this. But increasingly, there's a lot more complexity, and investors are getting a lot more knowledgeable in this area. So it's shifting down into areas such as conventional oil and gas as well. So not for us, it's not necessarily about, riding the growth wave of a lot of this sort of stuff, but it's about what you don't invest in as much as what you do invest in. So we definitely avoid the oil and gas pipeline industries, any of that midstream fossil fuel energy infrastructure we don't hold. Even things that you kind of on first blush don't kind of screen as high carbon intensity, something like a railroad that services large coal mines, for instance. You know, you think a railroad, that's got to be a good ESG kind of investment or sustainable investment. But if it's servicing, a lot of its revenue is coming from a large coal mining region, then there's actually a lot of stranded asset risk in there, even though an asset like that doesn't have high carbon intensity itself. So it's very important to kind of look through the kind of top level data and to look actually what your exposure and your risks are underlying that. So yeah, I mean, there's a lot of opportunity as well. There's a lot of growth. You know, like I mentioned, the expansion of grids and the growth of renewable energy is quite substantial in the next 5 to 10 years, but there's a lot of risk there as well. And one of the risks for infrastructure investors, particularly who want to invest in sustainability, is that they get pushed into the kind of clean tech space and away from the nice, stable monopoly assets. And so the approach that we've taken is designed to remove the risk, the stranded asset risk, but still maintain that defensive profile that we think infrastructure should have.
Okay, great. Thank you. That's really interesting about what you were saying about really looking under the bonnet for exposure to those carbon intense industries. I'm sure investors think that is really important. On the other, can you share some stock examples, some success stories maybe of companies really embracing renewable energy?
Yeah, sure. And it's probably not surprising, but a lot of the European utilities are ahead of, say, the North American utilities. So companies such as the restructured E.ON, which is a pure play grid player, that type of asset in Germany and Sweden, and perhaps Elia in Belgium, and there's Turner in Italy. These are electricity utilities that adjust the poles and the wires. And they will have a nice kind of tailwind of growth coming from the expansion of renewable energy, because for every solar and wind farm that you build, you have to plug it in with a big extension cord. So 90% of all new build renewable energy is grid connected. And for every dollar that these companies spend on expanding the grid to meet this growth, they then get to earn a rate of return. These are fully regulated assets. So what that means is that they have existing cash flows, and these are going to grow incrementally, and this is going to increase the amount that they can pay out to shareholders in the form of dividends. So we really like the companies that are paying a decent dividend to shareholders and that can grow that dividend through time.
Great, thank you. And how has COVID-19 disrupted businesses in the portfolio and their supply chains, and how have they overcome those disruptions?
Transport infrastructure has obviously been the most impacted. So for us, about 15% of the portfolio was in assets like airports and railways. And so we're talking, because of where they're listed, predominantly European listed airports and Asian listed passenger rail. And obviously when COVID hit and the shutdowns were implemented, these assets suffered volume declines of up to 95% for the airports. So that was a huge impact. We saw share prices off about 55% at the deepest part of the trough. Some of these recovered quite strongly, particularly in the last quarter of last year when the vaccines were announced. But they're still down anywhere between kind of 20 and 35% from their highs in January over a year ago now. So that's been the biggest impact. For us, it's important to be at the quality end. So if you're thinking about an airport concession, it might be a 50-year or 100-year concession. So if you take out 2 years of cash flow or 3 years of cash flow, the impact on the valuation of the asset, if you just did a discounted cash flow analysis, isn't that large. But where it can really destroy capital is the debt levels behind that. So if you have a highly levered asset, yes, in theory, the lack of cash flows won't impact your long-term valuation, but if you can't meet your debt repayments and your debt payments, your interest payments, then you're in a lot of trouble. And you then have to do very dilutive equity raisings. So for us, it was about really, our process is about investing in the highest quality end of the spectrum as well. And it gets back to that risk reduction. So the other thing I probably should have mentioned earlier is that for infrastructure, again, being a defensive asset class, you've kind of got to flip your understanding of risk versus return. So actually, to increase your returns, you take less risk. It's the opposite of what kind of modern portfolio theory would suggest, but actually the top performing infrastructure kind of strategies over time, and it has outperformed global equity, has outperformed by protecting on the downside. So our investment process is about identifying the highest quality, not just from a sustainability perspective, but from a balance sheet perspective, from cash flow, stability perspective. So, going through COVID, it was pretty rough a few months there, holding assets like airports and passenger rail. But we are comfortable with the holdings that they have enough liquidity in their balance sheets. There's enough of a buffer there that they will come through this. And ultimately be able to start paying dividends again. And the value, the long-term valuation shouldn't take that much of a hit. But yeah, definitely transport infrastructure was the most impacted by COVID.
Okay, and on that note, where do you see the sector and your portfolio, the companies in your portfolio going from here? Do you have any predictions for the next 5 years, say?
Oh, that's always a hard one. So we the predictions going forward is that travel volumes will return, obviously slower than a lot of people ever expected, but the transport infrastructure stocks will recover. The high quality ones will do well. It's funny, people tend to have quite short memories, so it's a little bit controversial, but my prediction is that after COVID passes and the vaccines are rolled out, everyone will be raring to travel again. So we're comfortable maintaining that kind of 15% allocation to transportation infrastructure. Again, we are investing at the very boring end, designed to provide dividends and stability to investors' portfolios. So we certainly don't kind of identify any sector that we expect to shoot the lights out. It is really about providing, a nice steady return. And then if markets do crash from here, provide some downside protection to that, and then ultimately outperform in the long run. And that renewable energy trend that we talked about before is definitely going to provide incremental growth to a lot of the stocks that we hold in the portfolio.
Okay, fantastic. Well, thank you for sharing your insights. We always finish the Green Dream video with one final question. Can you share your favourite sustainable snack or drink?
I have a little bit of a sweet tooth, Nelly, and I suspect you get this answer a little bit, but I'd have to say fair trade organic dark chocolate.
Great, I like that too. Well, thank you very much for your time, Ursula.
Thanks very much.